That was the financial sector unmentionable hitting the proverbial fan. Welcome to the Property Imperative Weekly to the 21st of April 2018. Hello again, I'm Martin North, the Principal of Digital Finance Analytics. We start this week's review of the latest finance and property news with the latest from the Royal Commission into Financial Services Misconduct. After the shameful disclosures relating to poor lending practices, bad advice, misaligned incentives and poor regulation last time, now they have been looking into the nether regions of financial planning and advice. And guess what? The same behaviours are evident again in spades. Bearing in mind that 48% of the $4.6 billion annual revenue from the wealth management sector goes to the big four banks and AMP, they were forced to admit their mistakes in public. And you can watch our separate video on the detailed findings, more cultural badness from the finance sector. But here are a few highlights.
Mr. Regan, you're the Group Executive for AMP in relation to advice and New Zealand, is that right?
I am indeed.
And you've been put forward by AMP as its witness to give evidence in response to a series of questions that the Commission has asked in relation to misconduct concerning fees for no service.
I have.
And you've only been in your present role since 1 January 2017.
That's correct.
But you were already a Group Executive of AMP at that time?
Yes, I was.
And as at 1 January 2017, the change was that advice was added to your portfolio of responsibilities?
Broadly speaking, yes.
You were already the Group Executive for New Zealand?
Yes, I was the Managing Director for New Zealand and in that role part of the Group Leadership Team.
I see.
But the title wasn't formally Group Executive.
I understand. And the Group Leadership Team is also referred to as the GLT, is that right?
It is.
And the GLT reports to Mr. Mellor?
That's correct.
Mr. Mellor is the CEO of AMP?
That is correct.
And your immediate predecessor as Group Executive for Advice was Robert Caprioli?
That's correct.
But as you've indicated, you were already the Managing Director of AMP New Zealand, and in fact you've been at AMP for about 20 years, is that right?
Since the 30th of June 1999, I believe.
I see. Almost 19 years. And the GLT, that also includes Brian Salter?
It does.
And Mr. Salter is the General Counsel for AMP?
Yes, he is.
And he's been in that role since about 2008?
That would be approximately correct.
And Mr. Mellor, in addition to being the CEO, is also the Managing Director of AMP?
That's correct.
And he was appointed as CEO in January of 2014?
I believe so.
And ultimately, the GLT is responsible for implementing the policies and strategies that are set by the AMP board?
Yes, they are.
And Mr. Mellor, as Managing Director, is a member of the board?
Yes, he is.
And the current Chairman of the board is Catherine Brenner?
Yes, she is.
And she's held that position as Chairman since June of 2016?
I couldn't recall that off the top of my head, but it would be very close.
All right. Was this apology agreed to by the board of AMP?
This is my witness statement.
Did the board of AMP, as far as you're aware, resolve to make an apology?
No, I didn't seek their approval to make the apology.
All right, and they didn't authorise you to do so?
Well, I'm authorised to give the witness statement.
Was the apology something that was, to your knowledge, discussed by any committee of AMP?
Not that I'm aware of.
Was there anybody else employed by AMP who was involved in the drafting of your statement?
Yes.
And who was that?
Our legal team.
Okay. Was Mr. Salter involved in the drafting of your statement?
He would have been, he certainly was familiar with the statement. Yes, he was involved with the statement.
Right. Was Mr. Mellor involved in the drafting of your statement?
Mr Mellor has seen a draft version of the statement, I believe.
Did he provide any comments on your statement?
Yes, I believe he would have.
AMP apologised unreservedly for the misconduct and failures in regulatory disclosures in the advice businesses as a result of the Royal Commission, and announced that Chief Executive Officer Craig Mellor will step down from his role with immediate effect. The Australian Bankers Association admitted that the issues raised had been unacceptable and do not meet the high standards the community expects, rightly, of the banks. And the Treasurer announced significant increases in the penalties ASIC can impose. The government will increase penalties under the Corporations Act to, for individuals, 10 years imprisonment and or the larger of $945,000 or 3 times the benefits, and for corporations the larger of $9.45 million or 3 times benefits or 10% of annual turnover. And the government will expand the range of contraventions subject to civil penalties and also increase the maximum civil penalty amounts that can be imposed by courts to the maximum of the greater of $1.05 million for individuals, from $200,000 now, and $10.5 million for corporations from $1 million now, or 3 times the benefit gained or loss avoided, or 10% of annual turnover for corporations. And in addition, ASIC will be able to seek additional remedies to strip wrongdoers of profits illegally obtained or losses avoided from contraventions resulting in civil penalty proceedings. Now, these increases are right, as before, the financial impact of poor behaviour was very, very low. However, do not be misled. Changing penalties will not address the fundamental cultural, structural and economic issues which have combined to deliver a finance sector which is simply not fit for purpose. We need to remove incentives from the advice sector, including mortgage brokers. Actually, we need a unified regulation across credit and wealth sectors. The two current regimes are an accident of history. We need structural separation and disintegration of our financial conglomerates. We need a realignment of interests to focus on the customer, which, by the way, is not at odds with shareholder returns, as customer focus builds franchise value and returns in the long term. We need cultural reform and new values from our finance sector leaders, and executive pay should come under the spotlight. We need a reform of the regulatory structure in Australia because they are captured at the moment, at least by groupthink, and their interests are aligned too closely to the finance sector. This must include ASIC, APRA, RBA and ACCC, because all have bits of the finance puzzle, but no one is seriously accountable. But there is a more fundamental issue. We have relied on overblown credit and superannuation sectors as a proxy for high-quality economic growth. And this has inflated housing and lifted household debt and GDP. But we need a fundamental economic reset because reforming financial services alone won't solve our underlying issues. The government, who resisted the Royal Commission, has now also indicated they are receptive to expanding the scope and term of the inquiry, which in my view should include regulation of the sector and the macro-prudential settings which are in place. So write to the Commissioner and your MP advocating a broader scope. Finally, on this, it's worth noting that former Deputy Prime Minister Barnaby Joyce went with a full Monty confession. He said, "In the past, I argued against a Royal Commission into banking. I was wrong. What I have heard so far is beyond disturbing." Joyce, of course, is now a backbencher and is free with his opinions. As another story with current ministers, they continue trying to score political points over Labour, which had been agitating for a Royal Commission long before it was set up. But my suggestion is that this financial mess is so significant that both sides of politics should set aside party differences and focus on the main game. What happens next will fundamentally determine the future economic success of the country, no less. If we continue with the current set of assumptions, we will run the country into the ground as the debt burden becomes unbearable and savings for retirement are devalued and destroyed. It's that serious. Turning now to more immediate economic news, the latest lending stats from the ABS underscores that the great credit binge is ending. You can watch our recent video where we discuss the full results. But to start at the end of the story, we see significant falls across most states in investment lending flows, with the most significant falls in the Sydney market. The share of investment flows continues to drift lower to around 35%, but that's still substantial. Finally, the percentage of investment lending of all lending flows is below 20% and shows a small fall, but we also see a small fall in business lending to around 55%, excluding investment property lending. The ABS also released their March 2018 unemployment statistics. It was not good news, with the trend unemployment rate rising slightly to 5.6%, although the trend participation rate increased to a record high of 65.7%. WA has the highest rate of unemployment at 6.4% and is still rising, whilst rates in New South Wales and ACT also rose. The HIA released their latest housing affordability report, claiming that affordability improved in most of Australia's capital cities during the first 3 months of 2018 as house price pressure eased. But this is largely spin, as their calculations do not necessarily take account of the now tighter and becoming even tighter lending standards now in play. And in any case, in most centres, affordability is still well below long-term averages. But of course, they are advocates for the property sector, so there should be no surprise. There was important evidence of the rising cost of funds this week, as ME Bank says it has lifted its standard variable rate on existing owner-occupied principal and interest mortgages, effective April 2018. ME's standard variable rate for existing owner-occupied principal and interest borrowers with an LVR 80% or less will increase by 6 basis points to 5.09%. Variable rates for existing investor principal interest borrowers will increase by 11 basis points, while rates for existing interest-only borrowers will increase by 16 basis points. ME CEO Jamie McPhee said the changes are in response to increasing funding costs and increased compliance costs. More hikes will follow across the industry, together with reductions in rates paid on deposits, as the fallout of the Royal Commission and higher international funding costs take their toll. For example, the 10-year US bond rate is moving higher again, following a slight fall earlier in April. Have no doubt funding cost pressures will continue to rise. We discussed the whole question of debt and the potential trigger for a recession in a recent video blog, Global Debt and the Upcoming Recession. The outlook looks more and more like our Armageddon scenario, as we discussed in detail in an earlier program. 4 scenarios, none good. Worse, regulators in the USA and China are both weakening banking regulation at this time of high risk and high debt. Oh, and by the way, we think it's quite possible the RBA will need to do its own form of quantitative easing down the track, and that they will most likely buy pools of residential mortgages, yes, including those with breached lending standards, to assist the banks in their liquidity, to assist home prices to rise, and to allow the debt bomb to tick for longer. Sound of can being kicked firmly down the road. And that would be the time to buy Australian equities and even property. Maybe we need a scenario 5. We released the latest Digital Finance Analytics Household Finance Confidence Index for March 2018, and it shows a further slide in confidence compared with previous months. The current score is 92.3, down from 94.6 in February, and it has continued to drop since October 2016. The trend is firmly lower and below the neutral setting. You can watch our separate video on this, why household finance confidence fell again. But in summary, across the states, confidence is continuing to fall in New South Wales and Victoria, was little change in South Australia and Queensland, and it rose in Western Australia. There were also falls across all age groups. Turning to the property-based segmentation, owner-occupied households remain the most confident, while property investors continue to become more concerned about the market. Those who are property inactive, renting or living with parents or friends, remain the least confident. Nevertheless, those who are property investors remain more confident relative to property inactive households. Based on the latest results, we see little on the horizon to suggest that household finance confidence will improve. We expect wages growth to remain contained and home prices to slide while costs of living pressures continue to grow. There will also be more pressure on mortgage interest rates as funding costs rise and lower rates on deposits as banks trim these rates to protect their net margins. Finally, we turn to CoreLogic's auction data. They suggest that fewer auctions will take place this week, with a total of 1,592 properties scheduled, compared with last week's final result of 1,915 auctions held. This is also lower than a year ago, when 1,751 auctions were held across the capital city markets. Sydney is set to see the most significant drop in activity this week. Turning to last week's final results, the clearance rate was 61.7%, which was lower than the previous week at 62.8%. Melbourne's final auction clearance rate fell to 62.4% last week, across a slightly higher volume of auction week on week. In Sydney, the final clearance rate fell to 61.5%, down from 62.9% the previous week, with volumes across the city remaining steady for the week. And clearance rates improved across all of the remaining auction markets last week, with the exception of Tasmania, which remained unchanged. Geelong recorded the highest clearance rate of the non-capital city regions, with 77.1% of 54 auctions cleared. You might want to watch my video on auction results under the microscope, where we discuss how the results are collated and whether we can trust them. So overall, there is little evidence to suggest that the property market is recovering, despite more from the industry claiming that this was the case this week. And we have yet to see the impact of tighter lending standards flowing through. Our survey data indicates that most households are finding it tougher to meet the income and expenditure hurdles now, and as a result, we expect credit and therefore home prices to continue to slide. And if anything, that fall will likely accelerate unless we get unusual measures in the budget, which, by the way, we think are quite likely. If you like what you've seen here today, please thumbs up the post and add a comment or a question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now. And I want to thank those who have already subscribed. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.